everybody. Luke Gromen, FFTT. Hope you are well and having a great week. I know I am. Cavs are up 2 games to nothing in the first round of the NBA playoffs. Always a good thing when the Cleveland sports teams win. I don't think we've gotten our fair share of that over my lifetime, certainly. So, with that, we're going to jump right in. Thank you, as always, for the questions. Very helpful, helps thought process, and I just find it very interesting and helpful. And so, thank you. So, first question from AB. My question is, can you list the primary ways the U.S. government would likely delay or avoid the effects of the debt doom loop? Can they delay the effects indefinitely? Yeah, they can. They can absolutely delay the effects indefinitely. The number one release valve is the dollar. The lower the dollar goes, the lower rates go, the less of a debt problem there is. And so that's number one. It's really important to understand that the U.S. fiscal dominance is not a permanent condition yet. It's a function of the level of the dollar. The dollar goes up, the U.S. goes into fiscal dominance very fast. Dollar goes down, the U.S. gets out of fiscal dominance. We've seen this in the last 3 times in the last 2 years. We saw the U.S. deficit coming out of COVID over $3 trillion. We get an everything bubble in 2021, early 2022. We get booming tax receipts. By the end of fiscal 2022, the U.S. deficit has gone from over $3 trillion to about $1.1 trillion, just in an everything bubble. Flip side, Fed raises rates in 22, stocks go down, bonds go down. We get tax receipts in 23 that are disappointing. Fiscal 23, the deficit doubles in a year, with unemployment really not moving. What was the release valve? Weak dollar, everything bubble, receipts up, inflation up, and deficits go way, way down, which means issuance of treasuries goes way, way down, means global growth goes up, means global balance sheet to buy a reduced amount of treasuries goes up, treasury market stabilizes. You get the dollar down, you get inflation up, you get rates down. There is no fiscal problem. Flip side, 2022 into 2023, dollar up, rates up, stocks down, receipts down, issuance up, global balance sheet down to buy increased amount of treasuries. Oops. Treasury market dysfunction again, twice in 2023. 1Q23, 3Q23. Both times met with more dollar liquidity from Fed and or Treasury. So that's number one. So there's an easy way out of it. You give me the dollar or the DXY at 90, 85, there isn't going to be a debt spiral. The release valve will be the currency. Other ways not involving the currency, sure. Number one, the biggest, as we keep saying, is productivity miracle. And that can take a lot of shapes. That can be a happy productivity miracle or a not so happy productivity miracle, and depending on where you are. Look, if Russia and China have some sort of political changes at the top, more U.S.-friendly governments take over. They begin funding U.S. deficits again by buying large amounts of treasuries, pricing oil only in dollars. It's great for the treasury market. It's great for Washington, D.C. It's great for Wall Street. It's probably going to be terrible for the U.S. middle and working classes. You finish the job and apply the coup de grace of hollowing them out. And it's probably terrible for the world. Basically, it's going to be great for the those at the very, very top and pretty much nobody else. But that could prevent a debt doom loop. The next way, productivity miracle. Right now, this year, the U.S. government will spend about $3.3 trillion in Social Security and health and human services outlays, Medicare, Medicaid, Social Security. That 3.3 trillion compares to 4.5 to 4.7 trillion in receipts. So that's like 70% of receipts are getting paid to boomers, who also happen to be the wealthiest generation in U.S. history and maybe in human history. And so if there was something that happened that over the next couple years, enough boomers pass on quickly that it cuts 1 to 2 trillion per year in Social Security and health and human services, Medicare, Medicaid spending out. That's going to buy you a lot of time. That's 1 to 2 trillion a year less in deficits. And Boomers also have about $75 trillion, give or take, in wealth that if they passed on, some portion of it would flow to their kids who are in peak spending years, so that'd be good for growth. And the tax man would get his cut, so deficits would go down even further. So again, I didn't say all these productivity miracles were happy miracles. All I'm saying is, as an objective analyst, you're asking for how it could happen. That's how it could happen too. That's not a pleasant way, but it could happen. Small modular nuclear reactors rolled out on a Manhattan project scale speed. Fusion rolled out on that same scale. Both of those seem like Hail Marys at the moment based on what I'm seeing. AI could certainly be a productivity miracle, but it has to be rolled out fast enough that it is deflationary, but not so fast that it's too deflationary. Because if AI comes out too fast and creates 10% unemployment, 5% more unemployment, that's going to create a lot more issuance and domestic political destabilization, of which we're already seeing enough already if you look around. So you add some unemployment driven by AI on top of that, a reduction in tax receipts, an increase in counter-cyclical welfare payments with higher unemployment. That can be destabilizing as well. So those are some ways that it could happen. I'm not rooting for or calling for any of them. I'm simply identifying different potential paths, if you will. Next question from NS. Why is this time truly different? We've been hearing about the U.S.'s fiscal woes for over half a century, yet international buying of U.S. debt is at an all-time high, deepening the euro-dollar Gordian knot. Why should we believe now is different? I don't think it is different, and I don't think you should believe it's different. NS showed in the question a 1972 Time magazine cover asking, quote, "Is the U.S. broke?" showing Uncle Sam holding his pockets outturned with nothing in them. And it was an article highlighted by my friend Jack Farley and Mark Dow on a recent conversation on Jack Farley's podcast. Both of them failed to mention what happened in markets from 1972 to 1980 that allowed the U.S. to avoid going, quote unquote, broke. So let's list, how did the U.S. avoid that last time? Is it different this time? So from 1972 to 1980, the DXY index went from 110 to 80, peak to trough. Ultimately, it went from 110 to 90 within 18 months of that article, that cover appearing. CPI, after that magazine cover appeared, CPI year over year in the United States was never below 5% from 1972 to 1980, ever again, in that entire 8 to 9 year period. Even though there was a recession in there, CPI never went below 5. Okay, U.S. nominal GDP growth from 1972 to 1980, consistently 300 to 600 basis points above the nominal yield on long-term U.S. Treasuries. In other words, for 8 to 9 years, U.S. Treasuries at the long end were certificates of confiscation. They were trash on a real basis. Even during the 1973-74 recession, there's this view, long bonds would be a great to own if we ever go into a recession. We had a recession 73-74. Bonds yields came down, but they didn't collapse. And they remained well below the yield on nominal GDP growth because inflation was so high that you still lost money on a real basis in bonds in a recession the very next year after that magazine cover appeared. Okay, what else happened 72 to 80? Gold rose 16 times in 8 years. So my point in all of this is it's not different this time. The U.S. is not going to go broke, not nominally broke. It's going to inflate. We'll do whatever it has to do to avoid it. People saying inflation's transitory or, hey, by the long end are the ones that are saying it's different this time. Now, what is different? What is different this time is debt to GDP now is 120%. It was only 35% when that magazine cover ran in 1972. U.S. deficit to GDP, it's 7% now. not 2% like it was when that cover ran in 1972. The market value of U.S. official gold as a percentage of total foreign debt outstanding. It was 25% when that magazine cover ran. Basically, that's the amount, that's the percentage, the market value of U.S. official gold is collateralizing U.S. foreign debt. 25% in May 1972. On its way to 135% by late 1979, early 1980. You know where it is today? 7%. Gold would have to rise nearly 4x just to get back to where we were in May 1972. It'd have to rise 20x nearly to get back to where we were in 1979. It's way worse this time. And again, it's not going to be different in how it worked out. Governments don't go broke nominally. What they do is they inflate and they crush the real value of bonds. They crush bondholders on a real basis. And so most people still, it's going to be, I'm not saying it's going to be different this time. I'm going to say it's being the same. It's just going to be a little worse because the debts are higher, the deficits are higher, lower starting position in terms of where gold and some of these inflation hedges are. But most U.S. investors, we highlighted this from Vincent Delyard last week. The last 3 years, most investors are still moving money into long bonds. They've not put any money into gold. They've actually pulled money out of gold in the U.S. So most investors in the U.S. still don't own gold. They still don't own Bitcoin in any real way, if at all. And they still have a lot of exposure to long bonds. And I'm just saying it's not going to be different this time. I mean, entitlements were cash flow positive in 1972. We were 4 years in to Medicare, Medicaid. Now they've been negative, cash flow negative, for 10 years, 13 years. So that's that's my point. It's not different this time. People saying inflation is going to be transitory, or the people saying it's going to be different this time. Good luck. All right, from GM, would love to hear your suggestions on the sustainability of medium-sized businesses through the possible tough times ahead. In my opinion, it depends on the business. I think it's going to depend on management. I think it's going to depend on debt levels on the business, asset intensity of the business, margins of the business. And you know, I think there's going to be some modicum of bumpy times ahead. They could take a number of different ways, shape, and form, likely with a heavy political aspect to them in terms of how they develop from here. Perfect example. You're a U.S. manufacturer and we have a world war. Like, that's terrible. A world war is terrible. If you're a U.S. manufacturer, it's going to be great. You're going to boom. If you're a U.S. manufacturer and we have a new Great Depression somehow, that's terrible. So some of it is an aspect of something I always say, which is what's normal for the spider is chaos for the fly. You know, so don't be a fly. So you could run through that type of dichotomy for a lot of different businesses. In my opinion, there's a few things that probably, without being specific about a type of business or situation, that I think are probably good rules of thumb. If I was owner of or a manager of a medium-sized business, knowing what I think I know could happen in terms of a range of outcomes over the next 2 to 5 years. I want low debt. I want high working capital levels or high cash. I want to stay liquid, right? So when I say working capital, cash, high cash levels. I want to keep my inventory working capital low, cash high, right? Keep inventory turns high. I want to stay low over my skis, just broadly speaking. So if I'm managing or owning a long capital cycle business where I need to really make a big investment and with a long payback period, I would build very large margins of errors into my internal rate of return or net present value calculations before I approved any projects, and certainly before I took on debt for any of those projects. So that's how I would approach it. Without more specifics, it's tough to say more than that, but those are some rules of thumb that I think are pretty timeless, given, like I said, what I think I know in terms of the potential paths over the next several years. From JL, you talk a lot about inflating away our debt and dollar going away from reserve currency status, could you paint a picture of what that scenario looks like for the average American? I love listening to you and Lynn, but have a hard time tracking your conversations about potential scenarios for the next 2 to 10 years and seeing the ramifications for the average middle working class person. So first, a point of clarification. I don't think the dollar is going to lose its global reserve currency status. I do think we are well into, as in a decade, into a shift back where the dollar remains global reserve currency, but gold is resuming its role as global reserve asset from the Treasury bond, which had been the primary global reserve asset for most of the prior 40, 50 years. This is a vast oversimplification, so take it with a grain of salt. In my opinion, the impact would be something in the direction of the average working and middle class American would see when you talk about inflating away or yield curve control or financial repression. I think the average middle and working class Americans would see goods and energy inflation of 10 to 20% CAGR, compound annual growth, for some span of 2 to 5 years. I think they would see wage inflation of 8 to 10% CAGR for that same 2 to 5 years. In theory, on an operating basis, they're behind. If they have a fixed rate 30-year or 15-year mortgage, though, that rate is not going to reset. And so what ends up happening relative to their wages is they get a debt jubilee on their house. If you have a 3% inflation and then you tax affect it and you're getting 8 to 10% CAGR wage increases, your mortgage is declining every year on a real basis, even as your living costs are rising every year on a real basis, a little bit, more than your wages. I think your financialized assets, like bonds in particular, fixed rate assets, I think they get crushed on a real basis in that environment. And that's what the U.S. government needs. Like, that's how you delever. That's how governments always delever. That's how they quote unquote go broke. That's what happened last time. And again, I don't think it's going to be different this time. I think industrial and commodity businesses, investments, stocks do well. I think wealth and income inequality in this country moderate. I think you would see the below 80%, right? Whatever it is, the 0 to 80th percentile of incomes and net worth would see higher wage and net worth growth than those in the top 10% and certainly those in the top 5%. So that's what that might look like. You can take it a lot of different ways, but that gives some sense. From IR, if Treasury holders have assurances of liquidity between Treasuries and reserves, what risk does duration really have? Purchasing power risk. Perfect example, October 1973, oil's about $3. April 1974, oil's about $12. Everybody got paid. Everybody got paid on their treasuries. There's no risk. You just went buying, 6 months later, you're buying 75% less oil. You're with that same $1,000. So I don't think that's going to happen, to be clear. However, I do think we can, it's not, I was just putting a chart together today. In 1988, a Treasury bond bought you 75 barrels of oil. Less than 20 years later, bought a lot less oil, 6, 7 barrels, right? So it depends on your holding period, etc. But ultimately, purchasing power risk is your risk. From BV, what's your take on 10-year tips? I sold all my bond funds a couple years ago, except for a tips ETF because of the inflation. How are treasuries protected from inflation? How are the interest rates determined? In my opinion, having the tips is if there's no other inflation hedged long duration asset, I think better than nothing. I personally prefer holding physical gold and self-custodied Bitcoin as inflation hedges. And I prefer short end bonds for my fixed income part of the portfolio, which is small, but that's what I prefer. The formula for tips is based on government calculated inflation rates. So they have an incentive to understate inflation given their debt load. So like I said, it's better than nothing, but I prefer for the inflation and currency debasement side of my portfolio, Bitcoin and gold in proper allocation sizes. And then finally from DG, If you believe that China has taken control of the gold price, how does that impact another's view that at first gold and the dollar would go up together, and then the paper gold price could crash as futures contracts become worthless due to the failure to deliver in cash settlement? How do you see this end game playing out? So, a little bit of inside baseball background first. Another, capital A, Another, was an anonymous monetary blogger who wrote on some gold message boards back in the late 1990s and into shortly before 9/11 with another partner of his, FOA, which stood for Friend of Another. FOFOA, who has a really good blog, he was the one who introduced me to the thought process about 15, 16 years ago. And so that is who DG means when he refers to another. Definitely has influenced my thinking on monetary matters. So, to answer the question, dollar and gold are going up together as we speak, and have been really since 2014, when global central banks stopped growing holdings of treasuries, which is sort of like the start of the wind down of the system. If I recall correctly, Another also, I think he technically said, all paper will burn, quote unquote. And so in my opinion, that is somewhat open to interpretation. What does he mean by paper? Is it paper gold? Is it all sovereign debt? Is it all debt? And what does he mean by burn? Is burn literally go to zero, or is it on a real basis relative to physical gold? Gold, it is in theory possible. It's theoretically possible paper gold could fall to its inherent value, which is zero, right? If you've got 100 paper ounces and 1 gold ounce underlying 100 paper ounces, and someone claims that paper ounce, or excuse me, the physical ounce underpinning the 100 to 1 levered paper ounces, the other 99 paper ounces are worth whatever the cash settlement is in some sort of force majeure situation. To be clear, I do not think that's how it's going to go. I'm simply saying that is theoretically possible. I do think if you read into the Basel III regulation changes starting in around 2017 with the Basel III reforms and the treatment of gold and how it changed as a tier 1 asset under certain conditions, and then with the net stable funding ratios around gold for unallocated gold centered in London, with some of the bullion banks, too big to fail banks. And Alistair McLeod did some really good writing on that in 2021, which I would encourage you to read. To my eyes, there appears to have been some levels of macro-prudential preparation for the possibility that gold could go a lot higher in a relatively short period of time to make sure a gold spike didn't send the banking system into the abyss, as Bank of England Governor Eddie George said would happen if gold prices went too high back in 1999. One last thing I will leave you with, a quote from Another that I think plays into DG's question. This is from February 1998, direct quote from Another. Quote, any nation state can put its economy or currency on a gold standard. They only have 2 requirements: own a stockpile of gold and raise the price very high. In the past, when currencies were gold, a nation could not lower the amount of gold backing its currency, raise the price of gold, because it lowered the currency unit worldwide and created payment imbalances. Today, no nation or currency is on a gold standard. The first country that starts will own the rest for some time. Find me a country with many needed resources, little debt in relation to its assets, and a national pride to lead. Let them price gold at many thousands, not only in their currency, but also in their resources. The world would buy from them, cheaply in gold, but dearly in all other unbacked currencies. The markets would do the rest. Starts to sound like Russia, doesn't it? The large modern currencies of today have only debt-ridden economies to back them. They cannot change as debt blocks their path. To change is to live, and to live, some debts must die. The owners of much of this debt must lose if change is to occur. Even the new euro will not be backed by gold. It will hold gold only as insurance against the worst outcome, war. Yes, an oil state comes to mind. It could even be China. Interesting, right? That's 1998. At any rate, that's where we're going to wrap up for today. Again, as always, thank you very much for joining me. I really enjoy these discussions. If you like them, want more of this type of content, check out FFTT-LLC.com for more information about subscribing to our Tree Rings product. 10 most interesting things, what grabbed us about each one of them, if it is either confirming a way we'd been thinking about the world or often changing a way we had previously been thinking about the world. So with that, I'm going to wrap it up. Thank you again for your time. Go Cavaliers. We'll talk to you soon. Take care, everyone.